Accounting is the process of organizing facts and figures and relaying the result of that organization to any interested users of the information. This process doesn't just relate to numbers spit out by a computer software program, it pertains to any type of reconciliation. The subject of this course, Getting Started with Financial Accounting, is a subset of accounting. Financial accounting involves the process of preparing financial statements for a business. Here are the key pieces of the financial accounting process. Number 1. Information. Any accounting transactions taking place within the business during the accounting period. This includes generating revenue from the sales of company goods or services, paying business-related expenses, buying company assets, and incurring debt to run the company. Number 2. Business entity. The company incurring the accounting transactions. Number 3. Users. The persons or businesses that need to see the accounting transactions organized into financial statements to make educated decisions of their own. If you're taking a financial accounting class, your entire course is centered on the proper preparation of financial statements. The income sheet, balance sheet, and statement of cash flows. Number 1. Income statement. This financial statement shows the results of business operations consisting of revenue, expenses, gains, and losses. The end product is net income or a net loss. Number 2. Balance sheet. This statement has 3 sections: assets, liabilities, and equity. Standing on their own, these sections contain valuable information about a company. However, a user has to see all 3 interacting together on the balance sheet to form an opinion approaching reliability about the company. Number 3. Statement of cash flows. This statement contains certain components of both the income statement and the balance sheet. The purpose of the statement of cash flows is to show cash sources and uses during a specific period of time. In other words, how a company brings in cash and for what costs the cash goes back out the door. Here are the basic facts on the 4 different income statement components. Number 1. Revenue. Gross receipts earned by the company selling its goods or services. Number 2. Expenses. The costs to the company to earn the revenue. Number 3. Gains. Income from non-operating related transactions, such as selling a company asset. Number 4. Losses. The flip side of gains, such as losing money when selling the company car. Here are the basics about each balance sheet components. Number 1. Assets. Resources owned by a company, such as cash, equipment, and buildings. Number 2. Liabilities. Debt the business incurs for operating and expansion purposes. Number 3. Equity. The amount of ownership left in the business after deducting total liabilities from total assets. The balance sheet shows the health of a business from the day the business started operations to the specific date of the balance sheet report. Therefore, it reflects the business's financial position. Most accounting courses use the cliched expression that the balance sheet is a snapshot of the company's financial position at a point in time. Accounting is based upon a double entry system. For every action, there must be an equal reaction. In accounting lingo, these actions and reactions are called debits and credits. The net effect of these actions and reactions is 0, which results in the balancing of the books. The proof of this balancing act is shown in the balance sheet when the 3 balance sheet components perfectly interact with each other. This interaction is called the fundamental accounting equation and takes place when assets equals liabilities plus equity. There are 3 sections appear on the balance sheet: assets, liabilities, and equity. Standing on their own, they contain valuable information about a company. Number 1. Assets. Assets are resourcing a company owns. Examples of assets are cash, accounts receivable, inventory, fixed assets, prepaid expenses, and other assets. Number 2. Liabilities. Liabilities are claims against a company's assets. Usually, they consist of money the company owes to others. For example, the debt can be owed to an unrelated third party, such as a bank. Some examples of liabilities are accounts payable, payroll liabilities payable, and notes payable. Number 3. Equity. Equity shows the owner's total investment in the business, which is their claim to the corporate assets. As such, it shows the difference between assets and liabilities. It's also known as net assets or net worth. Here are some basic assets examples. Number 1. Cash. Cash includes accounts such as the company's operating checking account, which the business uses to receive customer payments and pay business expenses, and interest accounts, in which the company maintains a fixed amount of cash, such as petty cash. Petty cash refers to any bills and coins the company keeps handy for insignificant daily expenses. Number 2. Accounts receivable. This account shows all money customers owe to a business for completed sales transactions. For example, a business sells merchandise to business B with the agreement that B pays for the merchandise within 30 business days. The business includes the amount of the transaction in its accounts receivable. Number 3. Inventory. For a merchandiser, a retail business that sells to the general public, like your neighborhood grocery store, any goods available for sale are included in its inventory. For a manufacturing company, a business that makes the items merchandisers sell, inventory also includes the raw materials used to make those items. Number 4. Fixed assets. The company's property, plant, and equipment are all fixed assets. This category includes long-lived assets, such as the company-owned car, land, buildings, office equipment, and computers. Number 5. Prepaid expenses. Prepaid are expenses that the business pays for in advance, such as rent, insurance, office supplies, postage, travel expense, or advances to employees. Number 6. Other assets. Any other resources owned by the company go into this catch-all category. Security deposits are a good example of other assets. Here are some basic liabilities examples. Number 1. Accounts payable. This is a current liability reflecting the amount of money the company owes to its vendors. This category is the flip side of accounts receivable because an account receivable on one company's balance sheet appears as an account payable on the other company's balance sheet. Number 2. Payroll liabilities. Most companies accrue payroll and related payroll taxes, which means a company owes its employees money but has not yet paid them. This process is easy to understand if you think about the way you've been paid by an employer in the past. Most companies have a built-in lag time between when employees earn their wages and when the paychecks are cut. In addition to recording unpaid wages in this account, the company also has to add in any payroll taxes or benefits that will be deducted from the employee's paycheck when the check is finally cut. Number 3. Short-term notes payable. Notes payable that are due in full less than 12 months after the balance sheet date are short-term, or could be the short-term portion of a long-term note. Number 4. Long-term notes payable. If a short-term note has to be paid back within 12 months after the balance sheet date, you've probably guessed that a long-term note is paid back after that 12-month period. A good example of a long-term note is a mortgage. Examples of equity are retained earnings and paid-in capital. Here's a brief description of each. Number 1. Retained earnings. This account shows the result of income and dividend transactions. Number 2. Paid-in capital. This element of equity reflects stock and additional paid-in capital. The income statement shows financial results for the period it represents. It lets the user know how the business is doing in the short term. And you have to keep in mind that the company's performance is not just a question of whether it made or lost money during the financial period. The issue at hand is more a matter of the relationship among the different accounts on the income statement. Your financial accounting textbook homes in on a few income statement components: revenue, cost of goods sold, operating expenses, and other items of gain and loss. Number 1. Revenue. Revenue is the inflow of assets, such as cash or accounts receivable, that the company brings in by selling a product or providing a service to its customers. Number 2. Cost of goods sold. The cost of goods sold reflects all costs directly tied to any product a company makes or sells, whether the company is a merchandiser or a manufacturing company. Number 3. Other income and expense. You classify all other income the company brings in peripherally as other revenue or other income. Either description is fine. This category includes interest or dividends paid on investments or any gain realized when the company disposes of an asset. The revenue account shows up on the income statement as sales, or gross receipts. All three names mean the same thing: revenue before reporting any deductions from revenue. Deductions from revenue can be sales discounts, which reflect any discount a business gives to a good vendor who pays early, or sales returns and allowances, which reflect all products customers return to the company after the sale is complete. Here are some basic cost of goods sold examples. Operating expenses. Operating expenses are expensing a company incurs that relate to central operations and aren't directly tied to COGS. Two key categories of operating expenses show up on the income statement. Number 1. Selling expenses. Any expenses a company incurs to sell its goods or services to customers. Some examples are salaries and commissions paid to sales staff, advertising expenses, store supplies, and depreciation of a retail shop's furniture, equipment, and store fixtures. Typical retail shop depreciable items include cash registers, display cases, and clothing racks. Number 2. General and administrative expenses. All expenses a company incurs to keep up the normal business operations. Some examples are office supplies, officer and office payroll, non-factor rent and utilities, and accounting and legal services. Other expenses are expensing the company incurs that aren't associated with normal operations. Here are two types of expenses you typically see. Number 1, interest expense, the cost of using borrowed funds for business operations, expansion, and cash flow. Number 2, loss on disposal of a fixed asset. If the company loses money on the sale of an asset, you report the loss in this section of the income statement. This section offers an overview of the statement of cash flows. You prepare the statement of cash flows using certain components of both the income statement and the balance sheet. The purpose of the statement of cash flows is to show cash sources, money coming into the business, and uses, money going out of the business, during a specific period of time. This information is used by investors and potential creditors to gauge whether the business should have sufficient cash flow to pay dividends or repay loans. The statement of cash flows gives the financial statement user a basis for understanding how non-cash transactions showing up on the balance sheet and income statement affect the amount of cash the company has at its disposal. Financial accounting, which is done on the accrual basis, does not show the cash ins and outs of business operations. The statement of cash flows gives the user of the financial statements a better idea of cash payments and receipts during the year in two ways: by eliminating the effects of accounts receivable and payable, and by showing cash brought in by means other than the continuing operations of the business and cash paid out for items outside the scope of continuing operations, for example, for the purchase of fixed assets. There are three sections of a statement of cash flows: operating, investing, and financing. Each section addresses cash ins and outs that the business experiences under completely different circumstances. Number 1, operating. This section shows items reflecting on the income statement. The three big differences between the cash and accrual methods will be accounts receivable, which is money owed to the company by its customers, accounts payable, which is money the company owes to its vendors, and inventory, which are goods held by the business for resale to customers. Number 2, investing. This section usually shows the sale and purchase of long-term assets. The purchase of long-term assets reflects on the balance sheet. The sale of long-term assets reflects both on the balance sheet and income statement. It reflects on the balance sheet as a reduction of the number of assets the company owns, and on the income statement as a gain or loss from disposing of the asset. Number 3, financing. The financing section shows the cash effects of long-term liability items, paying or securing loans beyond a period of 12 months from the balance sheet date, and equity items, the sale of company stock and payment of dividends.